We don't get this like camera action.
Yeah.
Okay, ready?
Let's go.
Welcome to Advice Amplified's first episode. Today's guest is Micky Johal.
Fundamentally, no one thinks their CRM does a good job.
Micky has over a decade of experience in corporate finance and M&A in the IFA world.
And I think there's a huge opportunity with the level of tech and the pace of tech.
In this episode, we dig into consolidation in the IFA space and highlight the growing advice gap. We look at the impact of early education and the evolving relationship between technology and financial advice.
End to end, all the way from taking on clients to clients being able to see their total wealth. I think that'll be kind of a full breakthrough in the wealth management space, which just does not exist today.
In return, all I ask is that you enjoy the episode and subscribe to our podcast on your streaming service now. Thank you. Hey Micky, welcome to Advice Amplified. Our journeys into entrepreneurship started around similar time with Ningy and your journey with Truinvest. And when we met through Truinvest, what always struck me was how kind of clear and forward-looking your vision was around tech and application and opportunities of technology into financial advice to introduce those efficiencies and really power businesses up. So I thought it'd be really interesting to kind of dig into that and hear a bit about your journey there.
Yeah, I suppose when we started kind of Truinvest going back to 2018, it was, you kind of look at the market, I kind of split it into kind of three areas. You kind of look at the market, it's lots of different IFAs in there. And, it's a pretty fragmented market with not many IFAs using tech to the best ability. That's quite obvious with the level of information you get. When I was doing acquisitions for the likes of Matty Woods when I was an M&A and integration director, what became clear to me was there's so much operational efficiency to be gained if tech was implemented. Now, there's lots of different techs within the IFA space, but they don't talk to each other. And so when they're not talking to each other, it becomes more of an administration burden than an operational efficiency for businesses. And so for me, what's really important was actually when we set up Truinvest was to really focus on the tech side, because I think it's still a gap in the market to do that, and I think there's a huge opportunity with the level of tech and the pace of tech, and it's been so quick. I just feel that IFAs and wealth managers have just been left behind the rest of the market. The banking system is now kind of taking full speed, and lots of different shopping retail platforms are taking full speed, but the wealth management platform has just kind of stayed a few yards behind, and that's because people have adopted some old tech which can't change that quickly. And so I think we need a whole overhaul kind of the whole tech in IFAs, and that was one of the rationales really of reaching out to you, Pete, with Ningy, was to find a route through all of that, because I think we were on similar paths, as you said, around building some tech. And I think if we could build, or if it existed, a wealth management back office system end to end, all the way from taking on clients and accepting engagements, all the way through to recording the information, the annual reviews, suitability, all the way through to clients being able to see their total wealth, I think that would be kind of a full breakthrough in the wealth management space, which just does not exist today.
Yeah, I think like you say that kind of silliness around it, because theoretically it's kind of simple stuff, isn't it? And you see it being executed in other places and the impact it could have. And I don't know, some of the IFAs we talk to, they seem to do a really good job on, like, maybe they've got a great client portal, or they've got a great back office, or they've got some great processes, but they're falling down in one space or the other. And it's painful, really, isn't it?
yeah, no, completely. We, at Truinvest, we had, so if you kind of look at the stats, we had one advisor, one paraplanner, and two administrators effectively. And so we're very much kind of administration heavy compared to the advisor side, which I don't think should be the case. I think you should be working on a 1-1-1 basis or less. One administrator should be able to servicing two advisors. But I think the industry is so geared up, and because we're using lots of different platforms and lots of different suppliers, they just don't connect with each other. And I think they're missing out hugely on opportunities to create those kind of efficiencies and actually add value to their client journey. To add value, that's where, for me, it was always about trying to spend more time with clients. We were trying to create a people first type of culture, and that meant both for kind of the client journey, clients really understanding where they sat with their goals, their financial risks, where their investments were held, how much they were valued in terms of their investments on a live database, which just wasn't available. And then for obviously for our employees and advisors to have that information at a tap of a button, you know. And for me, as kind of being as kind of the management of Truinvest, it was really important for me and our investors to be able to get snapshots of the different businesses we acquired from the click of a button, which just was not available. But there's a bigger picture for me. I think, you know, I think there needs to be a bigger drive from the actual owners and the advisors to be able to push for something a little bit different. And that's where the challenge will come. One of the biggest kind of CRM systems has 40% of the UK wealth market. And that means a fundamental shift in people changing from one system to a better system. And how do they adopt that?
Yeah. Do you reckon that's the biggest challenge, getting people to, I suppose, get excited enough about where they could get to actually shift off whatever they're using right now?
Yeah, well, I could tell you I'm working with 4 wealth management firms. I've spoken to in the last kind of 4 to 6 weeks with probably a dozen more kind of wealth managers that use different platforms. And I can tell you, fundamentally, no one thinks their CRM does a good job. You know, it's adequate, it's reasonable, it kind of helps them do their day job and do their client work. But does it add value to their business? I don't think it does. And I think that's where the differentiation will be. I think, I think the biggest challenge, like you said, is getting that mindset shifted. You know, we've got a big trail of, people who probably aren't so well versed within tech, because they're, if you kind of look at the average age of an advisor within our industry, I suspect it's mid-50s. And so trying to get them to change and adopt new technologies is going to be a challenge, and I think that's where there needs to be kind of a push from somewhere, and an easier way and a solution for them to kind of adopt it.
And do you reckon they could ever be happy? I sometimes wonder this, like, is there, because like back office and CRM it's not cool, is it? Like, and yeah. I wonder, especially like you say with some of the people that are involved, is it a convenient excuse, or do you reckon there is that appetite? Speaking to those firms, they want something.
I think no. I think there's definitely an appetite. There is definitely an appetite. I think, every good IFA I speak to wants to do what's best for their people, and that's both clients and employees. And I think the biggest challenge is them trying to understand. And correct me if I'm wrong, but there's always going to be a little bit of pain when you're doing that transition from one system, which has been fundamental in your business, to another system. And I think trying to get their head around what does that look like, because these are very financially adverse people in a way, or risk averse is probably a better way to put it. And so for them, taking some level of risk, they really need to understand what does that disruption look like and how long for and what will be the impact. We are willing to take that step. But again, it's about understanding, what will it do to, what's the disruption? How do we do it? How do we implement it? How do we make this changeover? Because there's lots of historic data held in those systems, and we need to understand, how do we pull that information out? Do we retain it? How do we cleanse it? And often I think that, and you'll tell me, but often I think it'll need just as much investment from the IFA or the wealth manager than it will from the IT provider or back office system.
Yeah, I mean, there's huge like cultural change that needs to happen, like excitement about the shifting proposition there, as well as like actually tidying the data up. I suppose that's always the thing that strikes me, isn't it? Because it does seem like it should be simple, and like there's some really intelligent people that have been working on this for years and years, and yet stuff still is a bit rubbish. It's still like Excel, isn't it? Or Yeah. So I suppose like part of the value of wrapping businesses up together is that operational efficiency you can bring, and efficiencies of scale. I know loads of the firms we work with and chat to, that's probably their end goal, is to build a business that's exciting and big enough that they can kind of move that and extract some value. And I feel like it'd be really interesting to hear your like perception on that journey of building Consolidator, and what that looked like and felt like, and how you went about it even.
Yeah, I'm pretty fortunate from my circumstances that it was quite a pleasurable experience. But on that journey, I think there were so many things that could have gone wrong. It's me being part of the management team is one aspect, and the funders who backed us to do those acquisitions in another aspect. And then you've got the target businesses, the management teams within them. And so along that journey of trying to bring together 4 different businesses is often quite difficult and challenging, because there's 3 different parties to kind of satisfy on that journey, as well as kind of doing the due diligence and doing the legals. And so there's lots of challenges when you kind of go in to become a consolidator. But for me, it was a really good experience. And the reason why I kind of went into the space was because I felt, there were lots of opportunities within the space which weren't being delivered. And for IFAs, there wasn't much, or wealth managers, there wasn't much of a place to go. In our market space in 2018, when I started Truinvest, before that, all you had were the large consolidators. And I don't actually, I wouldn't even call them consolidators. Lots of them are aggregators. So they're great at buying businesses, but they're probably not so much at consolidating their business into a business. And they just tend to be a collection of businesses. And for me, the ultimate aim was to create one business, because I think that's where you create real value. And our whole journey was focused around, one was technology, for mention, trying to implement the best technology. Now, we knew we weren't going to build the technology. We wouldn't ever say we're going to build a technology from start to finish, but actually implementing what was best out in the market. The second bit was reducing group office costs. So trying to make sure we were as efficient as possible. So we were moving people from employee roles who had then group roles. And so, a compliance director in one company would move up to have a compliance role, working with a team within a compliance function. So moving people like finance, marketing, HR into those kind of group functions. The third one was looking at a centralized investment proposition. Many firms really do believe in having a centralized investment proposition around what they do. They don't believe all their assets will move on to a centralized proposition. I don't think everyone should, but if it's right for the client and it's pretty straightforward and there's a good case to do it, well, why not? The fourth one was around growth. So being able to help kind of these companies grow and giving them access to capital to be able to grow, but also on scale, there's only certain things you can do. On scale, you can start to build an academy, start to invest in your people. Take on more people through graduate schemes and then apprenticeships, etc. And that was one area we focused on. And the fifth one was really about trying to do what's better for our clients. And so, on scale, you can start to have some real discussions with platform providers to reduce the cost for our clients. And so they were the kind of 5 areas we really focused on. And the experience was, we got to, as a group, got to over kind of 9 million of revenues and 1.2 billion of assets within kind of a short period of time. And we did a lot of our integration during COVID, which was probably a good time. Everybody was available, everybody was at home, everything was shut. And so for us, the integration was always pretty clear from the start. But yeah, for us, tech was a big part. We were working with you and building some stuff, and we actually built some great software in terms of the compliance bit, if you remember, so, our compliance file reviews would all be done in one place and available at head office levels, as well as an advisor level to review kind of compliance, and scoring the compliance between, the RAG system, red, amber and green, so that was a great, benefit to what we were building, and that was built into our board reports. And every month we were getting to see which offices were performing well, which weren't doing so well. So, from an oversight perspective, that was great.
I suppose, like we hear a lot at the moment about, obviously, valuations are a bit frothy right now for businesses, and with changing kind of macroeconomic conditions, if you want, like how do you see that kind of consolidation or aggregation or general like amalgam of businesses, changing over the next few years? Or
yeah, it's an interesting. I think the next 18 months will be really interesting from a wealth management perspective, and I say that because there's been lots of cheap debts and private equity money out there over the last couple of years, with base rates being at 0.25%. And now base rates up to 5.25%. Many have fixed that interest rate, and so the actual businesses are getting quite a low base rate, low level of interest to pay. But that will soon change, and that's having to increase. And these businesses would have built their forecasts going back a couple of years ago, and not getting into the detail of it all, but they wouldn't have assumed a 5% growth in base rate over that period of time, and that's a huge impact on cash flow and growth of the businesses. Today, all I can tell you, that the market's hot as ever. We have seen significant growth from, over my kind of decade of experience in financial services. If I go back to 2014, multiples being paid in the marketplace on what you call maintainable EBITDA, which is the underlying profitability of a business, and was around 5 to 6 times. I can tell you for businesses, they've definitely gone up to 7 or 8 times, and for the much larger businesses, they're going up 9 and 10 times plus. And if you get over $1 billion of assets, you're in probably past the double-digit number. So the growth has been incredible, and I think there's lots of private equity money that's flowed in. When I started in 2018 Truinvest, I could probably name you a handful of private equity firms, but looking at the last count that was done by Citywire, there was 36, and I bet there's more than that. That's only 36 they found, but there'll be many more than that in our space, and it just shows you how that increase of money and cash flows coming into the business. People are chasing growth because they've got a facility available to them, and which they need to draw down upon, and so having to go out there and find opportunities and buy opportunities and pushing is just going to push up pricing, and it's done that over the last few years. Where do I see it happening? I've been told it's cooling down. I've not seen that myself more recently. There's lots of private equity firms still out there, and I still see some very aggressive multiples being published when I look at them. But I think over the next kind of 12 to 18 months, I think there'll be a cooling down of those multiples, and I think there'll be a big rethink by lots of these what I call aggregators around trying to build out that improving profitability, refocusing their efforts not on buying new businesses to bring into the group, but more focused on actually what they've already got. But there's some still frothy, some real frothy multiples being paid in our space for the right sized kind of businesses. And the reason for the size is, with bigger businesses, private equity who tend to be much bigger, will pay for a platform acquisition, a higher multiple effectively. And because with scale, as I mentioned, you can do so much more. You can start to build out your own CIP, you can start to build out your own platform, you can start to reduce your costs, you start to share group office costs. And so if you get the right platform in play, and you get the right type of people and management team running it, the multiples will be pretty high.
Yeah, I think it's a really interesting way of doing things. So we definitely, through Ninggi, we're lucky, and some of the clients we work with that they're, really forward thinking, excited to invest their time and money and energy into, doing new, exciting, cool stuff. But you've always, I suppose, like you say, with the consolidator perspective, that there's that operational efficiency and opportunity through scale to do cool stuff. But all of the firms moving into that are on an earn out where they're planning to retire. They don't want to interrupt the kind of the amount of cash they're going to get when they, walk off to play golf full time. And that doesn't sound like the best environment for innovation. And then on the flip side, if you're a new IFA trying to build a business, you don't want to be spending all your time playing around with tech and doing this and that. You want to spend time with your clients. It's that third way, isn't it? Of bringing some excitement through.
Yeah, and obviously, if I can align. If you can align the owner managers, who typically tend to be the guys that run or ladies that run the business, they tend to have the highest number of clients. They tend to be the ones that are trusted with all the other employees and advisors and the ones they look up to. Yeah. If you can get them to implement that technology or that innovation within their own businesses, if they're driving it, that change will happen. Yeah. It takes time. For me, it always takes time to build up trust and relationships. And that's why I often find some investment houses are really difficult, because they have that 3 to 5 year period of investment cycles. So they need to be out within 3 years or within 5 years. And that will come really quickly when you're trying to, at the same time, achieve real strong growth within the business through a number of acquisitions.
I'm interested in your thoughts on, because like you say, there's that kind of short-term view that a lot of investment houses take of, this is what we'll do, consolidate, strip out some costs, and there we go. Where do you see the industry in 5, 10, 20 years? What do you think the macro direction, I suppose, of travel for things will be?
For the wealth management space?
Yeah. The big questions.
Yeah, I think, what do I see? I see the regulators probably pretty happy with fewer firms to regulate. So I think in their view, trying to regulate less companies is in their interest. So I think consolidation will still be a big part of what's happening. So I think our industry will just be bigger and bigger. The amount of regulation that tends to come out to strip out, and the most common conversation I have with IFAs is around compliance. Them getting, the owner managers are typically getting sucked in back into compliance and having to kind of do a lot of the bulk work. Consumer duties, it's been implemented, but it's been a vast amount of work that's gone into it in the back end. And it doesn't matter if you're a 100 million revenue business or a £500,000 revenue business, the amount of work you have to do to make sure you comply is the same. And so there's no differentiation between the size of businesses when it comes to regulation, and I think that'll be a big driver towards less and less, because I hear it all the time. Lots of advisors have got into this industry to sit down with their clients and give advice, not to get pulled into compliance and all the back office. And so I think our market will certainly be dominated by much larger players. And I think even our smaller end market will be dominated by larger players. And if you kind of look at the network space with what's happening with Tenant and more recently being sold to Openwork, and you look at the Openwork side and and the regulation side, well, how does a network kind of regulate 100, 150, 200 firms? How do they make sure they're all complying and staying independent? So I think there will be also a shift, I think, to people having an in-house CIP because of consumer duty and consistency and platform as well, because it gives you that consistency with client outcomes really and fairness. So I think there'll be fewer firms, a lot fewer firms. I think there'll be some really large players in our industry, and I think there'll be there'll be less and less fewer firms. And I don't know the stats, but I suspect if you looked at the kind of regulatory kind of permissions being granted year on year, I suspect they're probably reducing. So I see fewer firms coming into the market, and I see more advisors kind of coming in and joining the larger consolidators.
Feels like definitely got to ask, because given we're top of the peak in terms of the hype wave for AI, what's your kind of thinking of how AI might disrupt or impact what advisors do and what their teams do right now, and how do you see that playing into the medium term?
Well, I think it's probably the biggest part really is if you can kind of get things like ChatGPT and how powerful something like that can be in terms of supporting whatever you're going to do, really, and the amount of knowledge it can kind of generate. That's the start. That's the infancy, and it's still incredibly powerful. And then you start to, for me, the biggest driver, so for our industry around AI is going to be personalization. So if you look at, I kind of think around this quite a lot, actually. If you kind of look at where we as humans are kind of moving towards, we're moving towards more personalization. And that goes from, I don't know, the Instagram adverts that might come on your phone, to your playlists on Spotify, to Amazon shopping, to your health through Zoe app, and, all these different areas where personalization is kind of taken off. I think, that the biggest kind of trend or the biggest thing for AI is going to be actually helping to personalize your clients, your outcome for your clients, your risk profile, your investment strategies. And what do I mean? So, as an investor, if I wanted to invest in or wanted a balanced portfolio in some shape or form, I could choose what I wanted in that kind of sphere around, tech be, I like Tesla, so I want, I like Elon Musk, I want Tesla stock. And, and that's how personalized I think we'll get. And at some point. And so I think there's a huge amount of work AI and tech can do. And, building, I spoke to you at Truinvest, and one of the concepts that you had was kind of building these, if you call them avatars, if you like, to give online advice. And so it'll help shape and I think bridge that kind of gap between what's probably been pretty unsuccessful in the UK, robo-advice, and so kind of more shift into this hybrid area, which I think is more palatable for the UK market. And I think what you'll see is human which will be touching on the more complex financial planning matters, and will be more on the emotional side. And then you'll have the kind of the robo side, if you like, blended with the human side, which will be more straightforward, more kind of administration, churning kind of the workload out. So I think it's quite an exciting time for our industry, and it'd be really interesting to kind of see it kind of move forward. And you know, like I said before at the start, you know, we're a bit behind, but I think, you know, this could really kind of lift it. And I think the next business that can kind of come out with something that can be embedded into a wealth management with some AI that actually works and can give that personalization will be pretty powerful.
I see. Yeah, that combined tech powering up humans rather than, you know, let's just throw the fat file on the internet and call it robo advice. It's,
yeah.
I mean, when you dig into consumer duty, there's so much in there around personalization and treating clients as individuals and tailoring your service to them. I think that's impossible at scale, but, you know, you use some technology like AI to help you.
Yeah.
You know, whether it's the suitability report, the comms that are going out, you know, pull out those more, you know, tailored threads. I think it's super exciting.
I think you're right. Yeah, that personalised service will definitely kind of lead through into what you just said. You know, in that, you know, right now you're right. You know, clients are going through a process. You know, most often than not, and I think, you know, trying to personalise that a bit more with support of AI that can do the kind of churning of so much data so quickly will just enable humans to be able to do so much more for their clients. And it's great because that's what, you know, like I said at the start, that's what wealth managers want. It's what, you know, the advisors want. They want to sit in front of their clients and they want to do more for their clients. And that's where the value they see fits.
How do you think we get more people to receive financial advice in the UK? You know, if we look back over the last 10 years, the advice gap's just growing, the agenda investment gap's growing, despite all this cash being thrown at tech and different things. Where do you see that problem being solved?
You know, we know there's a big, huge advice gap in the UK market, and there's less and less advisors coming into our space. So the gap's just going to get bigger. And the only way to give financial planning advice is to address that advice gap is for tech, you know. And how do you solve that problem? I think it starts from early age. So for me, it starts with education. And, you know, we seem to teach our kids at school about everything, but about what really matters is saving for a mortgage or your first job or pension or the value of money. And they don't learn that at school, and they don't learn that anywhere. It's until they start in themselves, and probably takes a few years thereafter to really learn what they should be doing. And so often people miss the boat on saving for their pensions, or don't really appreciate actually what saving for a pension means because they're pretty young at the time. But so I think, you know, if we can start from the education piece really early doors and educate people about financial planning, about the advice gap, about pensions, etc., about money and why it matters. And then I think moving on into kind of getting that advice through kind of a hybrid solution, I think, you know, somewhere where, because it's still a very personal thing, people still want to talk to somebody. And so, yes, you know, fronting it would be an individual or telesales, so there's lower cost ways of doing it. But actually behind the scenes, it's driven by technology. And I think that's going to be one way, because people do still need that comfort of talking to somebody and putting their arm and telling what they're doing is right and where they're investing is right. And then again, you know, personalization, you know, lots of youngsters, they want tech to be at the forefront of what they do, you know. You can see that with, you know, telephone calls, with video calls, with WhatsApp and all these kind of different tech and how we kind of communicate with each other's changed enormously over the last few years. And so that engagement with the younger audience has to change as well, you know, and so finding ways for that. I think, you know, through kind of bigger, you know, financial education, academies being kind of bringing more people into our financial planning industry, supporting that kind of growth through academies, etc. With hybrid robo advice, I think, you know, the market will have to be addressed. It's really difficult at this stage, and it's more of a long-term game than it would be a short-term, I think.
I think that's such a good shout. Yeah, educate people on the basics so they do it at the right time. You know, you can't can't be 50 years old and say, right, I've got 2 years, I want to retire at 52. What do I do? You're like, well, you need to start earlier and, get
I mean, the amount of people I've heard say to me, if I knew when they're in their kind of mid 30s, if I knew I'd saved up my pension when I was 18, 19, when I was working, and I'd put some money towards my pension as well as the employer contributions, my pension pot would be half decent. But they don't. They wait and they wait and they wait and they wait till they're in their 30s, and then they start looking at, have a bit more of a disposable income and start thinking about where should we put it, and they start putting it into their pension. And it's just that lack of education, I think.
Yeah, we've got a couple of people in the team that literally, joined Ningi straight out of uni, and they're so good with their money. And I look at them and I look at where they're going to be when they're my age, and I get a little bit mad if I'm honest. I'm like, fuck, what was I doing? Spending it all on cars and stuff. But you do a couple of little points of adjustment in there. I don't know. They're so much easier to handle, isn't it? If it's your first paycheck, put a bit of that into your pension versus I need to put a big chunk of it, and I'm used to spending that when I'm 30, 35. It's really powerful. It's great to hear you say, keeping, bringing more people into the profession and keeping that personal contact. So I personally get annoyed when you hear that it's going to be sold through robo-advice, or your tech's just going to do it all. And because, like you say, you're buying your first house, or you're retiring, or you're investing for the first time, you want to sit down with a person.
To get someone else's opinion, and someone who's been there many times before, and you want to pick their experiences and ask the right questions, and you want the right answers from them. And so, no, I'm with you on all of that. I think I don't think it'll be going any time soon. I think people and financial advice are here to stay, but I think supported, empowered, as you call it, by tech is the way forward.
Thank you. It's been a super enjoyable chat, and appreciate you.
No, cheers. Yeah, it's been great. Thank you.